Last session we EFT formula. Recap of the futures. Recap. Started with the futures. This session on the future, combining with techniques of hedging. We started with the futures. I'll just do a recap. Futures parties would be there. One would be buyer, second would be a seller, and the buyer of the futures contract would expect the price to go up. He'll profit when the price goes up. The seller of the future contract expectation is price will decrease. He will make a profit when the price decreases. Obligation for both parties to perform, and the liabilities are unlimited. Gains are unlimited. What we have. Then we spoke about difference in option and go back and read. Margin is the important part here. Then we spoke about something margin. How the margin has to be paid. Margin has to be paid by both the buyers and seller of the contracts. We did some question. This was the important part. I'll do a rediscussion. Carried on throughout now. How the future price is calculated. Practical life we have the future price would be slightly different from the spot price because of certain reasons. All that has could be interest rates or could be because of the opportunity cost. So TFP spot price plus cost of carry minus dividend. We calculate 12 months TFP. I give the data 100 rupees. Let's suppose interest rate is 10%. TFP would be spot plus cost of carry minus dividend. 106 came. If the actual future price is not 106, there would arise arbitrage opportunity. TFP greater than spot price, we call it as contango. Less than is backwardation. Now, I have taken an example. Now, moving towards first, this was example number one. Assume example number one, which we got at theoretical future price 106. Now, two ways of reading it. It means if I diagrammatically put 0 period and 12 months, the spot price today of the share is 100. The future price which we calculated, since we calculated future price, we are calling it as a TFP, theoretical future price, is 106. Actual future price can be anything. If actual future price is not same as this 106, then there would arise arbitrage opportunity. Second part of variety of question comes is this part here. Now let me look at this part. Using data of example 1. Data of example 1, that means 106 we had. Using show the arbitrage process, actual future price is 109. That means if I go back here, as per the market, the actual future price is 109. Whereas as per you, the future price should have been what? 106. Now, as per you, things should have been 106. Is trading costly. Costly items, entire FM sell. That means you will sell futures. Understand what I'm saying? Will sell futures. Since it's a costly item, will sell futures, and it's a hedging position. Actually, if I tell you very frankly, let's suppose I know that future price as per me should have been 106. That means if I do the agreement to settle here, say I should be doing at 106, but in market it is available at 109. This is costly. I will do F minus the future market. Now, if you do F minus, understand a problem which happens. Now, let's suppose after the 12 months, if the price becomes 109, you are neither at profit neither at loss. If the price becomes 150, since you are F minus, you will be under a loss. Whereas we want to create an arbitrage, hence you have to create a strategy using a cash market. Future was costly, we sell futures, and second we do is spot cash. The cash market we buy and sell. No matter what the price becomes after a 12 months of time, our arbitrage profit would be difference of AFP and 3 rupees answer would no matter what the difference happens. That means there exists a arbitrage opportunity. AFP 109 is not equal to TFP. Since AFP is greater than TFP, price is greater than TFP, that's R. overpriced oblique overpriced oblique overvalued. Hence the strategy should be sell futures, that's SF minus, and buy spot. Sell futures and buy spot. The call you have taken is by looking at the future price since this was overvalued. Sell futures, buy spot. No matter what the price becomes after 12 months, the arbitrage profit would be rupees 3. Difference of this. In case you by chance forget what has to be written, etc., then remember at least one thing: difference of the actual market future price and the theoretical future price would always be the answer. Now, in exam, would he ask or not, I don't know. But I would suggest, since it comes for 8 marks, always show also by assuming numbers. So that if anyone is clear about the concept, if by chance he says prove the answer at different prices, then it's okay. If he does not say and it's a 8 marks question, always show the justification. Otherwise, this kind of a strategy anyone can write. Not there. Now, what exactly will happen in zero period? Arbitrager never takes money from his home. He'll borrow one hand, invest, create a strategy. At the end, everything would come back to him. If I go today would be loan taken 100. He'll take a loan of 100, cash inflow, buy the stock at 100, inflow outflow gets cancelled. Then bought the share 100, taken F minus. What we are ignoring is here margins. So that's a basically limitation of the method. Hence, the strategy is not so straightforward. If you ask me, if I go back standing to 20, if I go back approximately almost 17, 18 years back, there was huge opportunities in the arbitrage. Now almost negligible opportunities are there. Since market are matured, arbitrage opportunities are not there, but in the come back. So in this case, one of the limitation is that will have to pay the margin, which has the opportunity cost, which we are ignoring here. So objective is zero period, take a loan, buy the share, take F minus. Now what we have done is, no matter what the price becomes after 12 months, I've assumed 3 prices of my choice. If he gives, you take that. If he does not give, then assume anything. Either it becomes 80, 109 and 150. Now two positions you have. One, you bought the cash market share. So what you bought the share, what you do is, what you purchase the shares, if the rate is 80, sell at 80. If the rate is 109, sell at 109. If rate is 150, sell at 150. Cash inflow. Settlement of futures. Settlement of future means, sir, we were F minus. F minus will give me profit when price falls. In first case, my F minus was at 109. I'll have 29 of a profit. In this case, nothing. In this case, loss. Then, since you bought the share and we are expecting a dividend of 4, that is also limitation of the method. Because dividend will come or not, we do not know. If we receive the dividend 4, 4, 4, and then you repay the loan 100 plus 10% minus 10. And if you check the arbitrage profit. Again, I am repeating how the steps was taken was by looking at the future prices which was trading in the market, what you calculated. If there is a difference, the difference of these two would be the answer. Always yes. The objective would be, by looking at this, you will take a call. If actual future price is costly, sell future, simultaneously cover yourself in the cash market. If you do not cover yourself in the cash market, then you cannot create an arbitrage strategy. Then you are leaving your position open, because simple F minus and F plus is basically leaving your position open in the market. Once you have done that, then zero period 3 steps will take place: taking a loan, and then buy the share, create a strategy, and after that reverse that strategy. If you look at that, then we'll do. Check it out, please. Questions which have come has come on this front only, although there could be reverse scenario can be made. 99% questions have this front only, which the price is costly and cash market is S. Let me read out a theory with you. Types of arbitrage. There are two types of arbitrage. What we have covered is the first one. There are two types of arbitrage. What we have covered is the first one, cash and carry model. S plus F minus. S plus is buy in cash market, you are long, sell in the futures market, you are short. Reverse cash and carry model, I'll come back. This is what we have done, and we took call by looking at our future price with the actual future price. Futures are overvalued, overpriced. Interest is a expense, dividend is a income which comes out, and accordingly we have taken a call. Then we have the if reverse case is there. Let's suppose our value came 106 and the actual price was 102. Futures was cheaper. So in that case, we'll do F plus. The moment you do F plus, it's a S minus. This strategy on the papers, it would be very odd because you cannot sell cash market something which you do not have. For the purpose of theory, I'll be showing you something in portfolio also, short selling. Short selling, actually short selling is you sell something which you do not have. Futures, short selling is permissible. F minus, F plus because it's FNO derivatives. In the cash market, you cannot sell something which you do not have, but for the examination purpose, theoretical world, short selling is allowed. Let's suppose anything comes in which futures are cheaper and the cash market will have to do selling. Even if you do not have, assume it to be short selling. So it's perfectly allowed in the market. You are short in this. This will happen when TFP is greater than AFP. We call futures are undervalued or underpriced. In this case, interest would be your income because you'll receive money and invest somewhere, and dividend will be opportunity lost. No matter what is the type of arbitrage, whether it's a cash and carry model or reverse and cash and carry model, arbitrage profit would always be difference of AFP and TFP. Read this slide, and again I'm saying slide make comfortable on your own by looking at the future prices, and then try question number 27 on your try question number 27. Do not look at the answer, try on your own at least the first part. Try question number 27 on your own, please. Discuss with you. Please calculate price of 3 quotes at 220, SC and at 230, FP 30, spot price. 1 year borrowing rate is given percent, expected annual dividend 20 per annum. expiry. Also examine arbitrage, the dividend rate. Remember, dividend rate is on the try this out. Its first step is to calculate T. Even if is calculation of T. TFP is nothing but spot price plus of carry minus rent. I think you end up getting is 2, and you get 220 plus 0.5, 25.75. Now, if it's a 4 marks question, 4 marks also I think 5 days to the working. I don't know. I mean showing, but highlight this profit for sure, because a person who's might not know what he's checking. You take mark your answers by looking at answers. This is the truth. No matter what I say, the truth. Discussing one method with you, I'll show you answers. If there is controversy, that will time permit. But sometimes it's a hard luck. You have to believe it, no matter what you do. Practical life, what we are doing now is applied, and the controversy which comes always comes on a topic a student never applies in the practical life. No one applies. There happens a problem. In this case, my advice would be justification would be there. Always show kind of working. Right clearly there exists a arbitrage opportunity because AFP is better than T. Futures are overpriced. By looking at that futures, although I write S plus F minus, but my S plus call was taken by looking at F minus. Then we say sell futures F minus and buy what S plus by taking loan. No matter what the price becomes after 3 months, arbitrage profit would be 4.5. Now after 3 months, what we say, price becomes either of the following: 150, 20 or 300. They're in the cash market, whatever the share. Then settlement of futures, receive dividends, repay loan with what? 0.25, 2.5, and point. So this was the straightforward TFP formula. TFP can be created into different forms. The 5-6 formulas we can, one of the formulas which generally we do is continuous compounding. Power is given the concept of called compounding. I'll just shortcut formulas of that. Done that later. This, sir, what have you written here? It's actually nothing but I generally write here steps what he would sell futures in 0 period, buy shares in cash market by taking, which was given. Exactly these can write in the along with that what you have taken. Then accordingly you purchase shares. You now let me go to EFP formula. I'll just give you one briefing, then along with the question modifying the formulas as an EFP formula. When it comes, it's there are two ways. If nothing is non-CC, and if there is a concept of CC, continuous compounding would. Let's suppose there is no dividend. There is no dividend. Let's suppose in PF spot price plus cost of carry. This case, EFP spot price in our R is continuous compounding. Table I'll show you that for RT. E value would be available to you, 99% available. If they do not calculate also that, how do we know E value has to be applied? Specify. And if let's suppose I say a 2% value non-CC, a 1 rupee will become 1.0, non-CC become 1 point slightly higher. Continuous compounding. It's actually moment by moment compounding, but I think right daily compounding, moment by moment compounding, because share price fluctuates every moment. Because share price is fluctuating in practical life. There is dividend income. Formula what we learned was with dividend income. spot price plus cost of carry minus comes out. In this case, if it comes, formula becomes this. Time value is important because of the timing, importance of time. Formula becomes spot price minus of dividend, spot price of dividend e to the power RT or RT. That becomes formula. And then could be if yield rate is given, then in this case, let's suppose yield and then TFP, then yield is your income. Dividend is actually objective of dividend is reduction in the TFP. In this case also reduction, if the amount are given, we apply the second formula. Percentage is given, for example. In that scenario, you'll do what? Spot price into e to the power r minus y. R is nothing but it's a interest rate. Y is compounding. For example, if costing is 10%, yield rate is your net costing comes 6% accordingly. And in this case, also in this case, you can also adjust this TFP. The interest cost can adjust accordingly. But generally, yield rate would be available with respect to the index. With respect to the index, reason because normally for the case of a shares, we have dividend rates. Because in the index we have 50 shares. Every share is not paying a dividend every month. Some can pay in the month of January, someone can pay in the month of Feb. For example, some companies will July, August, September, accordingly. That based on that, I am covering a report. How would we know, sir, what to apply? At that. P value would be given like this. P value is given. You have to apply the E concept. Based on 31/8/2011, stock index values risk-free rate 8% per annum, dividend yield on this stock or index, stock index with stock index. These are the dividend yield. This means per annum actually based on the monthly annualized is 3% if it's January, 4% if it's and in the Feb, March, and we are standing on 31st 11. Value has to be calculated. What should be the price of contract on 30,011? Our value is December, 4 months, which ideally when only single value is given, ideally single value is given. No matter what you try and do, your answer would be 22. Now by hook or crook, you have to arrive at this method. One another question arriving at. No matter whether you like or dislike, like this an answer would. Now how do we arrive, sir? 0.015. Actually, what will happen is my period which is relevant from the end of September till what I have. Since this is the relevant period, what we do is try to figure out accordingly what we our period. It's a interest will get adjusted. My period is falling. I'm standing what 31st of 1000. My value is these are per annum. I'll calculate average annual dividend yield. Divided by what? Sorry. Sorry. What price? What price is how much? R is how much? Some exactly power point. Some exactly power point. So 158. How much do we? 93. Double two. Values will come in. Five. Let me go. Page number 17. Data management. Next feature. Now the objective of this topic is you are trying to hedge your risk, manage your risk. Adjustment of beta basically we are trying to do is of beta. Beta risk parameter shows the relationship of a movement of a stock with the stock market. If market changes by 10%, beta is 1.12%. Market falls by 10, fall by 12. If the market increases by 10, you will increase by 12. This generally is done for the purpose of when there are some major events being, for example, Fed meeting, or let's suppose the RBI meeting, or election results are about to come, or there could be any other item which can disturb your portfolio. Now, one way is if you think that portfolio can be disturbed or portfolio can be into the heavy losses, you sell it off and move. The problem is you were fearing some event which is happening a couple of days, and in a hurry you sold off the portfolio, and that event turned out to be positive. Then you cannot buy your portfolio again. You will get at 5% above costing or 10%. Then there was a lot of brokerage you would have paid by selling a portfolio and buying it. Normal share talking about. Sell the share 1 2 lakh, it's okay. 100 crores. What a portfolio manager does is whenever his for example, I have a banking stocks and there is a RBI governor meeting and I am hearing that first action by them, and that could impact the portfolio. That scenario, they will try to hedge their by creating such position in which for that particular period, no matter what happens, I could be safeguarded. Although on papers will be safeguarded to some as 100%, practical life things are very different. But we have to keep the objective of the theory in its way and the objective of the topic in it, that we are trying to manage a beta, trying to hedge our portfolio would be hedged in such a way that even if fluctuation in the market comes, we are protected. Beta management is portfolio managers do not sell their not sell their shares when they expect market down in near future. Some event being lined up, it is not necessary that due to some policy, market will safeguard the value the wants to hedge. Not based upon a short-term view, he would like to hedge his portfolio. Basic objective is to reduce the beta. I, I will not reduce the beta out. It's only I'll try to nullify the impact of beta. That's it. My beta impact is 1.2. Maybe for short period of a time, I'll create such strategy. The impact will be reduced. The objective is if it's a full hedging, will make beta zero. That's called desired beta zero. If it's a partial hedging, depends on if your existing is long, the new position hedging should be short F minus. Reverse also can be given in the theory world. That means if your position is S minus, you do F plus. That also could be done because you're trying to hedge your. Although short selling is not permissible, but for theory purpose, the formula which comes is number of contract to be bought or sold. Write down. Then I'll take one example to understand the flow and the number of contracts. Number of contracts to be bought or sold. Value of the design. Value of the desired minus divided by the numerator is known as numerator is amount value of portfolio desired minus of put divided by future price into lot size. Is value of portfolio is beta desired what you want to do of portfolio. With this example, we'll get the clarity of the recent examination as well as the examination. Treasure has hundred plus in the cash market of the Nifty future price. Currently, we are trading 20,000. Lots actually value actually the contract values which appear in market are around 10 lakh only. Standard con the lot size accordingly. Lot size is let us do only one case. After that, get habitual. Nothing to case one. Perfect hedging. Desired is the desired. That means make sure that effect of 1.4 first part in this. Find the number of contracts to be bought or sold. Find the number how the perfect market too many percentage. The objective is to track zero. Means even if the market falls, have the nil impact. How the port track beta size 20. Lot size perfect hedging tracks to be how the perfect hedging can be a market 10. First part is number of contracts. Since you are already plus, the answer would come in the minus. Number of contract to be forward solution. Hundred lakh at zero price to answer negative that it's a minus your short position minus if minus. That means if you are a plus in the portfolio and if you are fearing some event you can decline the market by certain percentage, the price create a F minus. Sell futures. Sell T. Second part he asked was how the hedging was attained. Let's suppose the market decline. Market by 10%. Market decline. One is our Nifty position. Second is Nifty. Portfolio would be change in port will come as what is your beta of the portfolio? 1.4. Does not mean that portfolio will not decline. Whatever decline will happen compensate. So my decrease in value of portfolio will come. Value of market is I'll decline by 4. That's 14%. 1.4 into 10 percentage 1 point percentage I'll decline. Loss in value of port. Loss in value of port. The 100 lakh. Now this 14 lakh will be compensated from the Nifty. Sir, how would we compensate? Price. Ten percent profit. How much profit do we? 1000. Na? 1000. How many contracts? How 2000? And since for F minus profit, how many? That is exactly what. Basically, what we'll be doing is one of the formulas of the overall profit oblique percentage profit. How it say when you market change by 10, net impact on your portfolio, net impact on your portfolio, that means ideally there is 0, whatever you wanted, the market change called beta management. Not that your portfolio away from impact such a way decline is done. One type of question comes, what to do. Question number 42. Which position on the index gives speculator a complete hedge? Hedge means you want to desire to and gives which is complete hedge against the following transaction. Share of right limited is price. Of right limited has a long position S plus cash market rupees 50 lakhs. Bit of the right limited is 1 point of the 1.2. Now actually what you do is you find the number of contracts. Let's not even find the number of contracts. When you write a formula, write this formula, value of desired minus the portfolio, the numerator is nothing but amount to be hedged. And if I simply say if your beta desired is 0, then amount to be hedged is nothing. It's a value of a portfolio into beta of a portfolio. So value of a portfolio into beta of a portfolio is nothing but amount to be hedged. If you are already plus, you'll do minus. If you are already minus, you'll do plus. So I can apply a shortcut way of doing it. Comfortable, please. You write a formula, value of portfolio beta desired minus beta of portfolio divided by something something. Get exact number of contracts. I do not want here number of contracts. What I need is amount to be hedged, and I know this value has to be what? Be 0, complete hedge. My value of portfolio is how much? 3 lakh. And this is what? 1.25. 15 to 1.2. 62.5. That means I'll create F minus or F plus. I'll write here only. With respect to this, I'll create my portfolio F minus 65 lakh. I'll write it here only. Then he says, share of wrong limited is going to depreciate, has a short position. He has a short, that means S minus. He'll do F plus again beta times only. Sir, again beta times, how will it come by F plus? Because if you are in value of portfolio minus, minus will become plus automatically. It's 0.9 into what? 25. 0.9 to 25. How much do we get? 20.5. 22.5. And next part we have the share of fair limited is going to be what? Stagnant. Here stagnant. He has what position? Short position. S minus cash market and What you would 20 lakh 0.75 F plus how much amount? 20.7 how much? 15. Basically, so basically, what you have is 6.5 plus 20.5 F minus F plus F net position F minus how much F minus 25 lakh. Exactly a kind of hedge, and this generally a portfolio manager does also, depending on what kind of a shares is. Let me add another type of variety of a question. Ask you will have to combination. Number 6. Was long back I came after. Sam buys 10,000 shares S limit S at the rate of 25 per share. Obtains a complete hedge by shorting 400 Nifty. Now do not worry about why he is not even means maybe depending on some data he was gonna call shorting 400 Nifty. That means minus at 1100 each, closes out. This word is important, please. Closing out the if you are plus today, tomorrow you'll do F minus. If you are minus today, tomorrow you'll do plus. Position closing at the price of the next day has fallen by 4%, has dropped by what? 0.5. What is the overall profit or loss from this set of transactions? Let us put down. Trading off is another existing long short F minus. Now, prima facie I can make out whether profit or loss will come, and accordingly I'll start putting my answer. Is buying the share at the rate of what? 5 S plus, and the price has next day what? Fallen. If you are plus in something and price falls, you'll loss. Loss in loss. Prima facie. What today? How many? 10,000. 10,000 at the rate 5. Fallen by what? 4 percentage. 25 in. Can I do 90? 20? Complete 24. It's a low. Counter has given. This is basically called. You can call this as out squaring of your term can be. squaring off. Anything can be. Might give you wordings. Say I bought something of squaring off. Have Nifty for minus and Nifty has fallen in should Nifty get what? How many Nifty? Cash is not at the rate. How much? 1100. Examiner 5 years. How much? 4 lakh. 4 lakh 40. Then squaring off is buying. What? 400. Price has fallen. How much percent? 0.5. How much? 172. Lakh. How much? 7. Right. Other side these all S plus and F. Overall. Overall profit of overall profit of the 1000. S plus F minus nothing but the hedging. Exactly what he'll mention. You have to divide by whatever he plus minus. Can I move forward? Without question, the rough working. what we do. Let me try in this. Ram buys 10,000 shares of X limit, the price of which per share, the value 1.5. Next share he sells 5,000 shares of A limited 40% S money, having been obtained obtained complete hedge by NIFT 1000 each. He obtains complete by Nifty futures 1000. That means now with respect to F minus, and if I want to find out how much will do F minus, sir, 1.5, that's uh, what is the value of the portfolio. If I do it here, it was their value is, I take it 10,000 to 22 20,000. You look at the formula, that was value of portfolio in beta desired minus beta of portfolio. Amount to be hedged, if I look at, that's numerator, and since beta desired is 0, I can simply say amount to be hedged would be value of portfolio into beta of portfolio. Beta of portfolio was 1.5. Amount to be hedged would be equal to, with respect to this, 3,30,000, lakh 30. Now with respect to the S minus, here we'll do F plus, and amount is 5,000 in 40. That is the short selling he has done. Sir, how much short selling? It's 5,000 into 40, 2 lakh rupees short selling he has done. And how much is the beta? 2. 2 into 2 lakh, how much? 2, 4 lakh plus. Basically, if I stand at 0 period now, my objective becomes as, what has been done is 0 period is, if you try to look at, please, by 0 period, 3 things are happening now. 1, I am S plus of value equal to 2,20,000 in the shares of X. I am 2 lakh minus the shares of A. Because of the X share, I have a future position F minus of 3,30,000. Because of the shares of the A, I have a F plus position of 4 lakh. F plus and F minus combined I can take, and which comes out equal to 0 period is F plus of 70,000. And if 1000 is the value, I can even find number of contracts, 70 F plus. Basically situation is S plus in A, S minus, S plus in X, S minus in the shares of A limited, and Nifty futures we are 70 F plus net value. Because of different, actually we have seen the question just now, 42 or 43, in which one was giving F plus, F minus, net was short position. This net is what? A long. So long in the shares of X, short in the shares of A, long in the. Now he says he closes out his at the close price of the next day, when the share of X limit dropped by 2. You were plus and the prices decreased. What? Loss. Shares of A limited appreciated by 1. Price has gone up. And since you are minus, you will buy costly. This will also give you what? Loss. And Nifty futures dropped by what? 1.5. All the counters will, all counters are given. Loss come, what is the all profit oblique loss to the, what is all counters are given loss, and this is exactly a practical scenario. What you do in theory is, if nothing said, you accordingly do. No matter what you do, 99% whatever strategy you will create will have loss, and this also have loss. Now the argument can be done. Let's say, what is the use of hedging? Hedging is, does not mean that it will be your safeguard only. For example, when you go for the exam, get hurt, please. Lot of prayers, etc. Pandiji will something. It's only trying to safeguard things. Now you do not know will happen or not. Because you'll see, they'll give you the ring and you wear it, and you'll, cards will change. Not necessary, cards will change. And this is exactly a practical scenario, and 90%. They try their strategy well. Everything is well. They're trying, but they lose out. Only is sometime it can happen that actually with this it has mismanaged, but generally 99% cases have since relationship with the market. Short term actually relationship can be very weird. It represents long term relationship. Shorter term relationship can be distorted, but in longer term can take. But portfolio managers do hedge as per them. If they would not have hedged, then there is an uncertainty always. The hedging they might expect something can. So I'm creating my position. What I can do is, in fact, without looking at a format, let me try to do something. Let's try to do verbally if we would have done how the answers would have come. How much amount of a shares I bought in the X Limited? Lakh 20, and dropping is by how much? 2%. Simply tell me 2% of it. Simply in exam, this is the way you should be cross checking your number. Format putting is different thing, but you should know I bought something for 2 lakh 20, 2% decline. My loss should be 4,400. My loss. Now, how much you sold the A Limited? Lakh. It is appreciated by 3. Your loss would be 6,000. Complete 1,000 loss would. And Nifty net position was 70. Not the contracts. 70,000. Amount term is 70,000. I think yes, 70,000 to 1.5. How much? 1050. This should be combined loss. Which 7,000. Now let me try to see the format. Formats you can put accordingly. Line chart I make in the normal classes so that I get comfortable. Otherwise, simply you can do the examination pattern is what is written. What I generally do in the classes, I show them in the line chart first how exactly we stand. Comparison becomes easy. It was shades of X, status was S plus, number was 10,000, price 22, amount 2,20 to us. Then he says create a position. Using the status, since I am S plus, I create Nifty F minus, amount would be theta times. What I do is this is basically theta times amount to be. Similarly, A was basically A S minus 5,040 and will be S minus F plus, and amount would be 2 into 2 times. Net position comes 70. The number of contracts is minus plus automatically gets cancelled off there. Then when we try to put loss in the loss, then you can show 22 and the value declined by how much percentage? 2 percentage. The value declined by 2 percentage. The loss is how much? 40. Then loss in the A shares you was 40. 40 3 percentage. What? That's 6. And loss in 1,000 and how much percentage? 1.5. If you want to show the line chart, it's up to you, but at least you will have to show that how 70,000 Nifty came in. Maybe you can just write down maybe in the wording that with respect to the X Limited, Nifty is the minus, with respect to A Limited plus net position, and then exactly this individual question come on this part here. One more question I'll do you. One interesting, very interesting. I'll ask you by chance there only drive. I've on the drive. If download it, I go there. Let me cover up one question. You can have a multiple answers. I'll stick with the answer because 2 times the question come in the you have kept exactly this. This was one of the November 2000. Now coming back, it, trader is having in its shares worth rupees 5 lakh at current price and cash rupees lakh. The of the share port 1 point of the after 3 months the price of the shares dropped by determine current port beta. It's a bit of the portfolio port of share of cash in of share in rate of shares are how much? Value would be 85 plus 50. If nothing is set, of cash you'll assume and cash one more two. Yes, it is of the share 5 lakh divided by plus 0. First part, no one will have a challenge, 99%. Second part could be slightly challenging, some of us. But again, I'm saying if something comes second, third time, not make a first time it's okay. Cannot say what happens or what the answer. What I say, portfolio beta after 3 months, trader on the current date goes for long position on rupees 100 lakh. What about hedging? Want to find portfolio beta after 3 months time. New now data is there. Let me start here. Head solution I've given you. Help me out with the rough line chart. 0 period and we have to go. What is my value of a share in this? 5 lakhs. Value of cash I have is what? 15 lakhs. Value of share is 85. Value of cash is 15 lakh. Total value is 100 lakh. Of the share I have is 1 point. And I am also F plus on what? How much amount? I'm also F plus on Nifty 100 lakh. That's fine. Now during he says find the months how much shares drops by what? 3 point. If I look at scenario here, value value of share 82. Now look up please. Let me size. If my beta of the 1 point change in market is 1%, I will change. The market changes by 2%. Now please understand what I'm trying to do here is if I change by 3, my beta is 1 point. What would market change percentage? Reverse calculation we are doing please. Formula wise, if you are comfortable, write the formula. I'll show the formula I have written. But without formula, you should be able to. Generally, we speak language is what? The change in the market and our beta multiply and we calculate shares. I say I have decreased by 3.2 and my beta is 1.6. That means market would have declined by what? Percentage. If the market would have declined by 2%, then since I was 100 lakh plus in the decrease in market is percentage, I will have loss here equal to lakh. Loss would be equal to lakh. My value of cash, which is lakh, since loss is cash settled, my value which will decline here by 2 lakh, my cash balance will by 2 lakh. That means my new balance will be equal to 13 lakh. My new value of portfolio 95.8 lakhs. Now I say that with the change, look at the sentences how created. I 1.6, 3.2 decline, it market falls by 2, loss of 2 lakh which will be adjusted cash 13 lakh, 100 lakh portfolio becomes equal to what? 95.28. 100 lakh portfolio becomes 5.8. Decrease is decrease. 100 lakh becomes 95. Decrease is equal to 4.72. And now I can say when the market declined by 2 percentage, the portfolio declined by 4.72. Market declined by 2 percentage, portfolio declined by 4.72. How much is the uh, beta? Is nothing but if I change by 4.72 when market change by 2, my relationship I am capturing 2.36. Generally we say if 2.36 was there, we would have said market changing by 2 percentage, market changing by 2, I'll change by 4.72. Reverse calculation we are trying to do. Again I'm saying how the flow has to be there. Since I knew my beta, it's I changed by 3.2, found out what is the change. Market change, market came 2%. 2% market change, that means loss is equal to that. This loss will be paid out of the cash. Cash balance would be sorry 13 lakh. Portfolio already we have reduced shares. Cash is 13. Value of the portfolio 95. Call it as 100 lakh portfolio will become 95.8. The value declined by 4.72. When the market changed by 2 percentage, I changed by 4.72. What is my fact? Point? Want diagrammatical? Let me show you. In exam, I'll not make it. I'll just for the purpose of understanding that how the flow. Portfolio of this cash one. If anyone wants to remember the formula, this is one of the formulas. Portfolio we will learn. When we'll go again, we'll top share is percentage market. If I am 1.6 and 3.2, I only decline. Then what would have been the decline in the market? Market would have declined by what? 2 percentage. Market would have declined by 2 percentage. Market declined by 2 percentage. Trader who has a what position? Long positions will incur a loss of what? How much lakh? Lakhs. Sorry, 100 lakh into 2. Therefore, cash balance after 3 months is equal to 15 lakh minus lakh. That new value of share after 3 months 85 lakh into 98.6. Value of after 3, call it as a 100 lakh for 95.8. Line came how much? 0.72 of the one question only. Once you've done, some part of the answer would be there, don't worry. For the entire question, there is a 99% chance you will make mistake at one level. I think with such a confidence, 99% with you. Hint is also there. I'm not rubbing anything. General class I discussed. This question is not there with you. Don't worry. 68th question. By chance, you otherwise those from my book only. Name of the company ML Limited. Number of equity 1000. Beta value 1.5. Purchase price per equity. Purchase price per equity. Wants to hold investment till September 2021 with on the date of investment September tradable with lot size of 50 for each per investment advisor to please advise Mr. how to hedge his market available part calculate profit or loss of Mr. rises by calculate profit loss with the expiry following situation. Means you will hedge first that number of contract etc. Then it rise by 10% falls by fall by third part is what exactly I did with you scenario. All change. First to hedge. Let me hedging position. Hedge will do is what? Value of portfolio into what? You can do beta desired minus beta of portfolio etc. Or you can simply multiply there only. Calculate. Then second and try that out. The net answers. When once you get the first part answer, advise how to hedge market exposure. What position should we take in Nifty futures by the way? Long or short? Short. Already he is long. So take a short position. Tell me the number of contract to be short. 1. Now show the second and third. Key part. That is exactly same way Nifty future rises by 10%. I have done same thing I with you line chart. Try out Nifty changes by 10%. It rise by 10%. Nifty, let me show how much you are getting it 500 profit. Getting is of work. Very fair answer also shortcut. Exactly what will happen. Increases by 10 percentage. Your NF minus on Nifty. Portfolio 1.25 beta. Portfolio minus what? 5. Portfolio beta 1.5, and if the beta is 1.5, basically what will happen? Portfolio 1.25, profit of how much? 12.5. Profit in rupees comes 7 lakh into 12.5, 87,500. Nifty will give you what? Loss. Nifty has given you loss. One way of doing. Second way is directly you can write wordings. Second way is directly you can. Nifty price would be loss of it. First part answer. Profit or loss to Mr. P during the expiry. Loss on Nifty 17,500. 10. Gain on the stock would be 1. Second part, ML Limited falls by 5%. Actually, this is slightly differently given now. ML Limited falls by 5%. ML Limited falls by 5%. Falls by 5. Beta of the ML Limited was 1.5. The beta is 1.5 and falls by 5%. Market will fall by 4%. Be careful on this part, please. Area of a mistake is this. Beta of the share was given 1.25. His share price will fall by 5%. ML Limited share price that falls by 5%. Change in this will come as what? 4%. Market falls by 4, and then you can accordingly put down what comes. 5% fall in 7 lakh would be 735,000. The answer has slight change from the normal language generally comes. Can I show you that answer now? Gain on Nifty 100 matter what you do, that basically divide by 1.25 is 4% it comes in its basic purposes 35,000 will come. Market will change by 4 since the beta is 1.25 5%, right? Different language done exactly same. 7 lakh was the 7 lakh port. Then he has said the fall price might or risk might exactly the have something your own risk also. One question more I'll pick it. I have given in your notes similar question. One I'll do, one will do. Margin call question did nice already covered. Look at this formula from my book only. In your book will then you have 60. Anyhow 60 good from here I think might have given. Let's try out. Solving in available, that's a TFP formula plus the beta management. Index is 25,000, value of the 50 lakh 50,000, risk free 9%. Didn't now you have been given percentage get cancelled out. Beta of the portfolio 1. We assume that a Nifty future on the BSE for months is used as the portfolio next 3 months. That's a challenge which comes out. One future contract is 50 times the index. Calculate the price of the future price of the contract. My TFP formula would be equal to what price plus cost of carry minus dividend. Now since both of them are in percentage, I can subtract percentage. We have done here non-CC and e to the power 0.9 minus 0.4 by 12. Since he did not mention about CC, I have not done it. Although your alternative as C. So my value comes by 12. It's 25,000 F minus price of the contract. The wordings were price of the contract. It's not price of one futures. The price of the contract value will be 25 to 12,060 12 lakh 6500, and then he asking on to hedge na on to hedge how much hedging, how much is the value of the 50 lakh 3,000 desired nothing mentioned. Beta of the portfolio 1.5, and this you can directly write 12 F minus 6 F. Now second part, look at please what happens. This value which you got here in first part TFP, how many months? 4 months. Then he says calculate the gain or loss on short futures position. Short position, you are already short, F minus only. If index turns out 22,500 after 3 months, if index turns out 22,500 after 3 months, you are standing in part when you calculated price formula, you are standing how many months? 4. and he is standing 2500 after 3 months. Months plus 1 month, make it 4 months. Our value will become, if I look at my answer here, will be after 4 months. That means you are already standing at 1 month. It's 500 plus cost of carry, the interest minus dividend yield 1 by 12, get this value, our value. And what was the position taken at 25? The value turns out to 22,556.5 to 50 lot size. Actually, first answer here only. Last price of the future in contract are for the. Basically, what has happened was, first part he asked to calculate T. Second part he gives actual price after 3, trying to convert into comparing at the 4 months end. You're trying to convert in the give the answer also normal way. First page times is not mentioned, especially not applied, has to be separately. This was basic. What we did was current future price calculated was 12,500, hedge ratio of contract 6. Then what we did after 1 month additional by 1 month, because once we were standing, we have taken 1 month. So alternatively, we have given using first values of what we did. First price, first calculation of contract were found for this, and have given other 77. Second time not enough. Also came in exam. That came in one exam, came in another. That's I half-heartedly wrote daily compounding formula is not. First time when it came, not mentioned. Avoid any controversy. No matter what they do, controversy will come in the exam. No matter how much you avoid, controversy will come. Second time when it came, clearly. CC should not be used. In fact, if it is not given, not be there. Exactly right this one. Fine. Now I'm doing couple of questions. Are there in our portfolio? Might not have. Actually, that question involves some data calculation. Everything is out of. By chance, if you have, or if you have the live, that there will be uploaded. 70th, which comes combination of a portfolio plus the beta management. That will be a lengthy exercise. Number first I'm covering is 8. 8 number question. Have the books with you? Okay. Some of you have notes they give you. Not, not enough. Some rest of what? For watching and at the portfolio. Because earlier I thought I'll cover with the portfolios, derivatives. Again I'll have to come back to that data management, etc. that I said. Read question number 68 once. These are lengthy questions, but if you do not make a mistake, first part, then rest parts will not have mistake. Problem challenging is with question at least 68 has a problem. Next question will not have a problem. This 8, if you're comfortable first part, then only do it, otherwise will not do it. Once from it, then I read out with you. It discuss with read out the question and tell you. And I want you to try it part of it. Your calculator on April 1, 2000, investor had a portfolio. Sorry, market price, number of cost of capital for the investor is now CC values also. Investor fears a fall in the price of the shares in near future. Accordingly, he approaches for the advice to protect the interest of this language should be clear to you. Investor fears a fall in the price, that means he's fearing. Whenever he'll fear, that means he'll do hedging. Accordingly, he approaches for advice to protect the interest of can make use of the following info. Current Nifty price is spot price 500. Nifty is traded in lot size 25. Futures for May are currently quoted 87 and are being 8850. These are actual future prices are required to calculate beta office. This is the lengthiest part in the question. Beta of the portfolio when you calculate. Third part I'll discuss. Beta of the portfolio when you calculate, you have to multiply market price into number of shares, you'll get amount. Multiply market into number of shares, get amount, and then you will get the total amount. The total calculate the rates, and then multiply beta and calculate weighted average. Weighted average beta will help solve the question. What you can do for me is, want to try out the exercise. Figures are blank here. Up these count. Cross check. I'm not even asking to write down. Get the hint of it. How lengthy the FGA. market prices, number of shares, count, the any one of you can cross. Numbers are right. And first part is okay. It's 1.102. Now let's go back. Try to read this. The examiner has not enough. For example, what he says, you are required to calculate. Second part now. You are required to calculate theoretical value of firing in or the contract firing in. Now, value here values. Number of Nifty contract, that's the hedging. Now my TFP formula would be what price in power RT. What price into RT. If I calculate, sir, actual price are given. The actual given. He's still asking you to calculate theoretical value. My own price, if I calculate, that is what price is 8500 per point. No, point 2. We are standing in the month of April. Into how many months? 3. June. 8500. I've taken June 1st. Point 5. 0.05 value is available. Calculate the value April, May, June. 3 months. 500. 1.05. That value would be not a challenge at all. When you calculate for May, problem is giving 8500 in per point 2. How many months? By 12. Per point 0. Problem is I have given that value since not given. Even if you know calculator does not know challenge which formula to calculate calculator. We are not calculating in step has to be twice gives you values, wants you to apply interpolation value that you formula calculation have in your what he from you. Once he will know how to calculate on the calculator, stop giving per point. or point sorry 0.01 value and interpolation from here to here difference cover this point double zero. Interpolation is not right of the capital bus. Interpolation is trying to reach 0.03 value, have to cover up this section from here to here. Difference for point 0.1036. Want to cover up the distance point double zero double three. 0.0103 divided by 0.00033. That value of each plus extra value 1.08787.787. Next part he is asking, that's basic interpolation. Next part he is asking the management. So the port is what 102. You have will tell you hedging has to be done of beta. Even beta desired to be what? Let me go back. For one thing, you will not use normalized value of beta desired minus beta of port divided by future plot size. You have to use actual future prices. These are statistical future prices. They are only for reference purpose. Not be used for the purpose of hedging will be actual future prices. Huh? Then he says number of Nifty actually reading is this. You are required to calculate number of Nifty contracts that would have to sell if desired to hedge until following. Now he has not mentioned what is the beta to be. If he does not mention beta reduction, it will be 0 always. He wants his total portfolio. That means normal formula value of portfolio which you got I think 9,94 something. Value of portfolio into beta desired 0 minus beta of the portfolio first part 1.10 divided by the price and the future prices will take which contract? The June contract. 50% of his portfolio. It's not beta desired. It's amount of the portfolio into 50 percentage and then 120% of his portfolio. What we do? Number of Nifty contracts to be sold for hedging. Value of portfolio beta desired minus beta of portfolio divided by what? Nifty price into lot size. Portfolio 994 in minus 1 point, get the value here 4.95 percent of the desired is 850 rounding of urban. Actually beta management I could have left it in the everything in calculation of the port entirely concept of derivatives. One A was Another question from here only. Seven zeros. Another question from here only. Seven zeros. This was much better. Easier stuff and calculation not enough. Right. The problem in the first problem was make any mistake in the first part. Since your subsequent parts are related, automatic at least the third part was complete. Cannot say step marking. Step marking goes even though they do not know what step to mark, mainly do step marking will go much better. Only data was simple enough, and you should time this actually in time you can without looking at try on your own that you know you take 10 minutes or 12 minutes. Accordingly, you will come to know for the exam. This question is one time more. Still, this time of question is justified. Says details about shares of any as below. Shares company. This is company AB. Number of shares, price per share, beta. Investor thinks that risk of is very high. Want to reduce the beta to point. We do not know as of now is high and want to reduce. Is considering two below mentioned alternative strategies. First is dispose of a part of his existing portfolio to acquire this. That means out of the total, it's there are two ways. One more question is there in the portfolio. I don't know whether I've taken. One is I have my existing portfolio. I want to add risk free and reduce my beta. Second is I have my existing portfolio. I want to reshuffle my portfolio, reduce something, add something new. Careful in the language. He wants dispose of a part of his portfolio. That means whatever amount he'll get out of that amount, some amount he'll throw and bring in risk free. The amount total will remain same. And there is another question which comes in the exam from the portfolio only. Is I have existing portfolio maybe 12 13 lakh rupees and he wants to add further, that is increase in the portfolio value. This is not the increase in the portfolio value. This is of some part and then part is basically portfolio. Or he says second, take appropriate action on nature which are currently and each point is worth two. It means you create that beta management technique. First part you are required to determine portfolio beta. Even if he would not have asked, still you have to calculate portfolio beta because how would you know that you want to reduce to what point? 9. Let's try out first part. The answer in first part is calculate the company A, B. Number of shares 2 lakh, 4 lakh, 2 lakh. Price you have 500 amounts. You can get these are easy readable amounts. You can multiply and cross check the lakh into 550, lakh into 750, lakh into value comes in 1500. Dates are 0.31. How did we get, sir? Paid by 5000. Get 0.3. The values first part. Second part he says is this free securities to be to point, brought to point. They let the weight of risk amounts of beta of the risk free to beta of the one that beta of the would be of risk of existing that. Now, if X represents weight of the risk free, the weight of the balance A, B, and weight of the balance 1 minus, because he is not changing the total amount 5000. Within that amount only shuffling is happening. If my new beta is 0.91, it's a beta is point risk free beta 0. That's 0. Weight of risk, the existing beta was 1. So I have to combine 1.3 weight of the remaining plus x into weight of that x. That should be equal to 0.91. So first part is anyhow 0 and this x 1 minus 100%. I get 30%. The risk purchase 5000 lakh in 30%. That means I have to sell some part of A, B such that their value would reduce totality by 1500 lakh, 5000 to 30, and I have to buy risk purchase by disposing of the 5000 lakh into percentage. Total will still be my 5000 lakh only. Will not change. What is changing? Changing is internally. Internal. Once you run the third part, done. Says the number of shares of each company. That means this 500 lakh which you has to be arrived at by reducing. Now how much to be disposed of? Same weightage what you have in the first part, you can reduce. Call them as number of shares plus the amount, number of shares. First we'll get the amounts, then divide by the share price to arrive at number of shares to of. Number of shares company to what dates. Dates are saying we are taking one amount to be disposed of 150, and since last number of shares, price of the company is 550 lakh divided by 5, 900 lakh divided by 150 lakh divided by number of shares to 0.9, 1 point. Now last part, number of now first part was basically this was relevant first, second relevant now. Number of Nifty contract to be bought or want to reduce Nifty contract to be, and he wants to prove also from you. You are required to determine value of the portfolio for 2% rise in. You have to make sure such a change that even after the entire port, the desired beta should come equal to what? Point. Have number of contracts to Value of beta desired minus beta of port size into lot size. We have 5000 into 10 to the power 5. I think desired beta is 0.91. That was what 1.120. So then he says he rises by what percent? If he rises by 2, what will be 1.3 beta? Your rise by what? 0.6. Profit in 5000 130 lakh. Profit in Nifty impact would be loss in what? Nifty. Loss in Nifty because you were short in Nifty. Old Nifty here, na? You were short and Nifty has gone up. So your F minus and price has gone up, and this will be 8125 into 2%. Overall profit or loss is 91 because of these. Portfolio gave you profit of 130 lakh. This gave you loss of what? 39, and percentage profit would be 91 lakh divided by 5000 in 1.8. Market change by what percentage? By what? 1.82. And one more same similar type, exactly table. So let me not with you. Yes, with on January 1 2 has exactly on the cost of capital is 10 point. Calculate the cost of the port. Will not have a challenge. Calculation of what you will do. Want to calculate, multiply all of them, then calculate of the port. Get point. You can just put down 0.85 as a beta. Subsequent parts you can. Subsequent parts are not challenging. Weighted beta is 0.8. Subsequent part I want to that will help. understand a basic problem, and sometimes you have to apply your own brain how to create an answer for the choice, this type of question. He says second, theoretical value of the Nifty contract Feb to not calculate. Then number of contracts of Nifty investor need to sell get full hedge that are desired until Feb for his current value of the 900. Nifty futures have a minimum size of 2. Assume are traded at their fair value. That means AFP and TFP both are same. Then fourth part, Nifty futures contract should trade if it desire to reduce the portfolio point. With desired beta is 0.6. Number of days in a year 365, and given now. Look at this part. You can put down in the copy because I'll be shifting this here. This is actually challenging. He has given, write down ln. ln is bracket 1.105 is 0.0998 from ln 1.105 0.0998 and e to the power 0.015858 1.1598. Now since only one value of e is to you, if you are comfortable what I'm doing now, it's okay. Otherwise, simply you know what you do. What price into e to the power rt, and this is nothing but r into t. He has given you the value. If by chance examiner becomes smart enough next time, then he'll give you two values. In this question, whether I tell you that concept, whether you're able to recollect that concept, whether you're able to absorb that concept or not, it's okay. You can simply do is, what is your value here? 50, 900, and 50, 900 into do 1.01598. How much do we get? Very good. You got the answer now? 5994.28. Got the answer. And then you can create your values of portfolio and so on. I'll ask you to do at the last stage. Now, my objective is, how do we get this 0.015858? If I'm saying it again, in exam this question, let's suppose not know you or anything, neither you have studied anywhere, let's suppose, then simply you have only one e value. Whenever there is one e value, na, not even question. Anyhow, you do not know how to do it. Take a risk, multiply simply this into this. But examiner next time will not be smart enough to 2-3 values. Understand? Now understand what is the meaning of it. Actually, when you write ln 1.105, bracket 1.105 means 10.5 of a non-C state equal to 9.98. 10.5 of a non-C state as good as 9.98. 9.98. And how did we get such 10.5? This 0.5. Also, second way of understanding. If there is a non-CC, non-CC means normal. 10.5 is there. If I invest 1 rupee at the rate of 10.5, after 1 year, how much will become? 1.105 na? Basically, two things to remember from here. 10.5 CC is as good as 9.98% non-CC. 10.5 10.5 of non-CC is as good as 9.98 of CC. Second important part is, if I invest 1 rupee at the rate of 10.5, it becomes 1.105, and in this case also it will become 1.10. Now let me show it. I know this is slightly difficult for you. Let me table with the table appendix for value. Look at this one. This is my value table. The power x, e to the power x is the future value, e to the power minus x is the present value. If you have, it's okay, don't have, it's fine. X values I'm seeing, x value, ln natural power x, e to the power minus. I'm just down below and I have up a rate power 1 1.6x value I picked up 1.6, and in front of natural log you have what? 0.47. Fine. 7 1.6. Now let me try to put, how do I read this number? Way of reading, x is 47, e to the power point is what? 1.60. Sir, how do you get 1. Let me look at x47 value. X is 47, power x value 1.6. And similarly, when I looked at x 1.6, in front ln value was what? 0.47. I've taken such value so that you get exactly comfortable level. Basically, when I write ln x value is 0.47, if I ask you, think, if x value, if rate is 47 percentage, 1 rupee will become how much after 1 year? 1.47. Continuous compounding, it will become how much? 1.6. Normal, it will become 1.47. Continuous compounding 1.6. Similarly, I have done it here. I have taken now this case. If x is reverse way 1.6, it becomes 0.47. Way of writing is e to the power x 1.6. Natural log 1.6 is 0.47. Now how do I read? 0.47 value, 0.47 e to the power x will give me what? 1.6. Similarly, try to read for me, if ln 1.65, if ln is 1.65, the natural log value is 0.50. Can I say e to the power x 0.50 should be equal to what? 1.50 approximate 1 point. So getting my point, what I'm trying. Exam not applies. Multiply and get the answer. Basically what you do is multiply by this. What I was trying to tell you was 1.105998. This is non-CC 5 is CC what? This value. Because you will get confused why it is given ln, why it is given. And now what I get is, sir, how did we get a 0.0 this value? Problem was CC has to be applied. We came to know 9.98 has to be used. It was not 10.5 has to be. 9.98 has to be. And I was standing January 1. I have to calculate value till Feb end. Generally, if I take, how would I calculate? I'll calculate 9.98 into 31 days of January, assuming 28 days of Feb. How many days? 59. And he said 365. 9.98 into 59 divided by 365. Do we get this value? Then do one thing, arrive at this value. Try with 50. How many days? 59 you said just now. Then if 58 cannot do. Already you are higher value na. When you multiply 9.98 into 59 by 365, value is coming higher than this. To bring it lower, apply 57. 58, sorry. Now I don't know why examiner creates such question. It is helpless. I have no idea. How do I know which day the expiry is taking? How do I know which day the expiry is taking? I do not know, but this answer comes with how many days? Comes with 7. Basically, I am expecting the mentioned what? He mentioned months. In this case, the problem was, how do I arrive at this value? One was reading this number 1.105 and this non-CC sorry, non-CC of this is CC of this. First problematic point. Basically, I have to arrive 0.015 when I multiply 0.0998 in 8 by 3. 5, then only I get this value. Now you do not ask me, how do you know 58 days? I do not know 58 days. I know I have to get this answer. I know I have to get this answer. And second part is, in exam, I would not have even applied the brain since only one value was. When he's mentioning the days, he should mention how many days you have to take. That means actually expiry is taking place maybe on the 27th Feb. Could be a possibility. Or maybe he has taken the contract at the end of the day. When we calculate a TFP calculation, right here, right, TFP date 10.5 was given to you. That was non-CC. That is same as 9.8% on CC base. That is same as 9%. Next time, at least this point he can attach with the smaller question. Then Feb future price would be 8. Something we have used the company how to apply the jugaad and write 58 to get this answer. I'm saying if anything you do not remember here, since you have got this answer now, last two parts you do 599 are comfortable with beta management. I've done extensive working on the beta management. Discomfort topic is now you do is for me the third and the fourth. Third is the perfect hedging. What answer is 5994 something? How much? 5994. 5994. I think this for me. Second and the third. Only problem will arises when you gives more than one e value. That you will have. Otherwise, the brain does. Yes, logically you can do. You'll be getting more comfort. Otherwise, illogically answer. Now, in exam, do not do this non-CC and he gives e value and then sir said e given that much of alertness. Generally, when he gives entire question, he has not mentioned as CC. He has not mentioned was given that it right. Try the third and fourth is desired beta is 0.7. Value of 4. I'll show you the value of 4. Sorry, value of 4 180 1 value of 4 into beta desired. First is 0. First is 0. Minus 0.85 divided by 5994.2 and dot size is 20 200. Sorry, 200. I move the answer. First part would be 13f minus. First case hedging is more. Second case is 0.6. Hedging is Done. Coming back to now. Let me do a couple of off-track questions. Valuation. Off-track one in the 45th. Off-track, not a normal. It's a binomial or a risk or actual. That's what normal question. 6 times or 7 times. Market price of R limited expected solving probability market price. Now we are moving to options valuation coming out of the beta management. Probability of occurrence market price. We have given 170, 190. Options are available. Size rate 5 6 market value price per. First is expected market price. This is challenging. 1 into I and get market price. Market price would be 170. Probable price basic. By probability price get first answer. Second part is expected value of call option for same. Now, if I was checking the paper, I could have given you marks assuming that 200 is exercise price or expected price. The call option, how it gives around every time they'll do is what? You have to compare this 200 with this option. Call option would be exercise when price goes up. It's a lapse. In this case, lapse different size exercise, and this will be 0, 0. This will be what? 20, 40. Multiply 0.2, 20, 0.5 into the value of the call option. How much? 10. The way it has done in the refer some book and they give the alternative. Do not accept the alternative. This is exactly done. Expected market price 170.5, 195. Value of call option is exactly same. 35th have I given? I can slide. By chance answer 69. This was actually the good thing about recent examination. When they're giving similar questions, one part they're adding something new. Right or wrong, it's material, but they're trying their level best. And this question, ninth, read out 16. First two parts you do it, third part, third and fourth, the type of question. Have purchased a three call option. You have purchased call option, Satya for a premium. Current market price 560, price 5. Check the price after. First part is simple multiply. Is 597. Value of call option at end of 3 months. Size price is how 590. Is exercise price prevails. Your actual market price is also value of option would be nil. Non-exercise it's a nil value. It's a nil. Price prevails. In case option is held to maturity, what will be the value of the call option? Exactly same. What you will do is basic. It's a 590. First case is what? Laps. Second case, third case, size. And value would be 10. Third would be 30. 590 na. Call option. Do not think about writer holder. Value is a value. Do not think about writer holder. For a holder, it's a profit. For a writer, it's a loss. Do not think what value means value. Premium. Multiply 0.35 into 10. 0.2 into this. 0.15 into this. Get 7. Whatever way you calculate, I don't know the answer. Next part is find out the price of the share quoted at the stock exchange. Value of the call option compute. Language can trouble you when the exam. It means you want your profit should come as what? 17. Value basically it says find out the price of the share. Want to find out actual market price quoted at the stock exchange, available in the stock exchange. Get value of call option as computed. Want 17 rupees. 17 rupees value of call option would come when your actual market price is greater than exercise price by how much? 17 rupees. It should be, if this is 590 plus 17 should be the actual market. Basically what he's trying to tell you in the English language is want to find out the such a price so that at that price the value of option should be what? 17, and value of option becomes 17 when you have 17 rupees more than the exercise price. If exercise price is 590 plus 17, fine. 560. There are some new parts. First three parts are common. That's off track question. Then on the option valuation method which comes is one of them is back show. One of them is because this at least theoretical part only practically because I first of all I do not expect, in fact to ask me very frankly, when you trade in the option market, unless and until you are using softwares, you are a trader, etc. I don't know, they also use software to calculate the option premium. Option premium are available. Best what a person does is he applies a put call parity by looking, because that is something which he applies by looking at what price some adjust at value of put comes to know whether they are properly valued or not properly valued. Interesting part is your institution asks question practically go and tell anyone calculate option three. That is very ask for anyone black shows the accountancy you do. I don't know. Ask your chartered accountant 10 years into 20 years or 5 years how much black shows or how much binomial or risk neutral whatever because that also has the confusion. Otherwise, it was straightforward binomial. One of now suddenly they have to create something problem. They have to increase your workload. There is nothing else. Problem is this method. I think last time theory wise, yes, they asked it. Practical wise, I think last time long initial years when the derivative was very new in 2007 8. After that, since chapter has developed so much, they hardly ask and are software which are novel price very difficult to ask. How you are a student, anything not study that will only come in the theoretically. Yes, they ask a lot of things. Option Greeks delta gamma vega theta rho or how does the factors affecting different factors affect the option and so on. That you should know by looking at formula. You should be able to create them out basically. I'll read out the theory part because very important and especially now I am assuming MC till 99% chance this term only they'll give in the slide itself. I don't know why I feel what they'll give I don't know but they'll give something from here or of Greek's option I have not taken delta gamma vega theta rho binomial cover tomorrow but some disputes between them how do you do it then there are delta approach or there could be replication try to look at us. What have to be done in the exam? What if by chance you get stuck somewhere, at least half part? That will speak out on this number. PSM as the number of steps. PSM actually basically what we call it as the number of steps. What happens is price change. Practical life we have share price change very frequently. Difficult to apply a step-by-step approach. That becomes actual model finite and the continuous compounding happens. Factors which affect option are stock price or spot price, size price, volatility. There are some assumptions are they were European. Earlier it was a non-dividend paying. Later on this was relaxed and markets are efficient. The state is volatility. European call option is at the form back home. One of the questions spot price into one. That's a normal distribution. Even value you use and then apply. What has to be done when you go back home? Certainly read. I think I might very by chance. How does the option premium facts gets impacted by change factors? Factors. If you can roughly work out, if you remember that when you go back home, factors because that is something very common theory. Practical, I'm assuming they are asking that's not justified at least this factors. When you go back home, in whatever books you are referring to, always write factors which are affecting option. Then they'll make out effects of that how different factors call option. Just give you a hint. How will you do? Certainly, we have not covered in the might get challenging. how I cover is, I do not cover up the put first. I look at this European call option. This call option is spot price into of D1 minus P of exercise price into, and then I write 6 factors here. Call option I am focused. Not even look at the put. At the formula, at the call option. If you look at the formula, European call option, spot price into of D1 price into what price increase. If this increases, look at this. If this increases, value of European, who is European call option, value will increase. Exercise price increase. Just put mathematical. Look at this formula here. Have a look at this. Try to visualize if spot price premium will, if exercise price increase after what? Minus. Best way to remember in the exam. Dividend income actually, when you go back, you'll apply some formula. Dividend reduces your, if you do the adjustment of dividend, adjustment what price gets adjusted. So accordingly that comes out. Not discussed with the dividend adjusted formula. There is something called adjustment of dividend. For example, when you're doing the TFP, what is the impact of dividend? Reduces na. So you can imagine from there, when you go back, you can look at your books, come to know. Time and volatility, these two are such factors. Higher the time, the larger would be the premium. Higher the volatility, risk is higher, premium would be higher. This is the only factor which goes hand in hand for call and put. That means, for example, if you're buying the option of a March, you're buying the option of April, May, June. As you go longer, the value will increase. It is not with this only. It will happen with sir shares also, TFP also. Let me show, because that is easier to show. In fact, let me show option. Larger the time period, by chance we have months. In fact, make it at the third. Now, 14 rupees strike price, 28 March premium is what? 1.3. And next is what? 1.85 and 2. Strike price is same. You know why the larger? Because time period is more. Second, sir, if I see here, 20 same. Because as the time increases, premium both wise increases because of timing. The timing is important, and that is exactly what I'm trying to tell you. As the time is more, risk is more, and volatility more. Again, the risk is premium would be higher, lower. You can remember from the formulas is what price this. You can remember this. You go back home, please look at this. You will be able to remember. These two will be simultaneous. Sir, rate of interest. How do you read? My way of remembering rate of interest is rate of interest in the entire formula is used after what? Minus sign, present value. If I have a 10% rate, leave the CC, leave CC, 10% rate 0.909. If I increase the rate, it becomes 0.833. If the value of present, if the present value factor comes down, automatically value will what? Comes down, na? If this comes down, automatically my call option premium will. Now, how to remember put is opposite, 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 opposite. This is the most important theory question, and I am 99% sure. I don't know why. First time, whenever if he gives a single MC, something will. So Black-Scholes has attachment. Could be delta gamma vega theta rho here for you for these weeks options, or they can ask you factors affecting. You go back home, open up whatever notes, try to make 6 factors which are factors. Let's suppose try to put in this formula. Time and volatility always increase with the premium. Rest just to the call option premium automatically put black show instead of entire calculation does not come because ample material to be given will not give you. Binomial they give it. This time they gave binomial and risk. Otherwise in binomial whenever they give solution is done by risk neutral. Solution is done by risk neutral method only. But this time specifically they asked binomial and they asked risk. That in the classes generally we do is delta. What we do is create some hedging portfolio, buy some number of shares when we are writing a call. Generally I do it, or there is a question called they are limited 5 1 or point 0.5 for example one call buy some option delta of shares, then we create that no matter what happens either price goes up or price goes down the value comes in based on that time they gave so that wanted risk neutral binomial difference. Otherwise when binomial comes first way of doing has to be probability. Institute what they have done and that also tomorrow. Somehow it appears very odd. These type of formulas you hardly apply. Yes, theoretically is okay, but they can mix rather than one formula, second, a third, a fourth. Otherwise, this chapter has so much. They can ask you any kind of a strategy. They can ask you trade. They can ask you straddle, strangle. They are commonly applied. Speak tomorrow on that and uh, a slight recap of the forex because you'll merge tomorrow currency derivatives. The forex. Take care and bye.